Same night, same technology, same spending race. Microsoft's stock surged. Meta's stock fell. Both companies are investing extraordinary amounts of money in artificial intelligence. Both reported strong revenue. Both believe AI will reshape the global economy. So why did Wall Street reward one and punish the other? Because the rules of AI investing have changed. The market no longer gives companies unlimited credit simply for saying they are building the future. Now, investors want proof that artificial intelligence is producing revenue, protecting profit margins, and generating real cash. And in this earnings round, Microsoft gave Wall Street a clearer answer. Meta asked Wall Street for more patience. That difference moved an extraordinary amount of market value in a single day. But before declaring Microsoft the permanent winner and Meta the permanent loser, there is something important to understand. Only 6 months earlier, the reaction was almost exactly reversed. Microsoft shares fell sharply after investors questioned its cloud growth and enormous AI spending. Meta's shares rose after its results convinced the market that artificial intelligence was strengthening its advertising business. Then, in July, the verdict flipped. Microsoft won the quarter. Meta lost the quarter. The lesson is not that one company understands artificial intelligence and the other does not. The lesson is that Wall Street is judging every new dollar of AI spending by a much stricter standard. To understand that standard, start with Microsoft. For the quarter ending in June 2026, Microsoft reported $90 billion in revenue. Operating income reached more than $40 billion. Net income reached almost $36 billion. Azure and other cloud services grew 43%. Microsoft Cloud generated more than $59 billion during the quarter. And for the first time, annual Azure revenue moved above $100 billion. These are not small experiments hidden inside a technology company. They show an enormous commercial machine already selling computing power to governments, banks, hospitals, software developers, retailers, manufacturers, and other businesses around the world. Microsoft also reported more than 30 million paid seats for Microsoft 365 Copilot. GitHub Copilot reached 50 million users. Copilot revenue accelerated by more than 60% from the previous quarter. This is the crucial difference. Microsoft can point to several visible paths from AI investment to AI revenue. A company can rent computing power through Azure. It can buy Copilot subscriptions for its employees. Developers can pay for GitHub's AI tools. Businesses can purchase security, data, finance, and customer service products that use artificial intelligence. Microsoft can charge per employee. It can charge per subscription. And increasingly, it can charge according to how much AI a customer actually uses. In other words, Microsoft is not only building the road, it is already collecting tolls. That does not mean the road is cheap. Microsoft spent about $41 billion on capital expenditures during the quarter. Roughly 2/3 of that spending went toward shorter-lived assets, mainly processors and graphics chips. The company also paid for enormous data centers, electricity, networking equipment, cooling systems, and land. Yet after this spending, Microsoft still generated almost $20 billion in free cash flow. That number matters. Revenue tells investors that customers are buying. Profit tells them that the company earns more than it spends through its normal business. Free cash flow shows how much actual cash remains after the company pays for the physical assets required to keep growing. During an infrastructure boom, free cash flow becomes the language Wall Street trusts most. Microsoft's message was not that AI spending would suddenly stop. The company expects investment to remain enormous. Its message was that strong cloud demand, paid products, and operating cash could continue financing the expansion. Wall Street heard a company saying, "We are spending heavily because customers are already waiting." That is very different from spending billions today and hoping that customers will eventually appear. Microsoft also possesses a structural advantage. It already has access to millions of businesses. Its software is deeply embedded inside corporate offices. Its cloud platform stores company data. Its security products protect that data. Its productivity software is used by employees. And its developer platforms help programmers create new applications. This means Microsoft does not need to convince customers to enter a completely new ecosystem. It can introduce artificial intelligence into tools that those customers already use. The company can place Copilot inside Word, Excel, Teams, Outlook, GitHub, Azure, Dynamics, and its security products. That creates several opportunities to turn the same AI infrastructure into different sources of revenue. One data center can support a cloud customer, a Copilot subscription, a developer tool, a security product, and a business application. This is what investors call operating leverage. The infrastructure is expensive, but if enough customers use it through enough products, revenue can eventually grow faster than cost. For Microsoft, the AI story is beginning to look less like a science experiment and more like a business model. Now, compare that with Meta. Meta also reported impressive growth. Quarterly revenue reached more than $60 billion, up 28% from a year earlier. Advertising impressions increased. The average price paid for each advertisement increased. And around 3.6 billion people used Meta's family of applications every single day. Artificial intelligence is already helping Meta recommend more engaging content, identify the advertisements most likely to interest users, and give businesses better tools for reaching potential customers. So Meta's core business is not collapsing, far from it. But below the revenue line, the picture became more difficult. Meta's costs and expenses increased by 55%. Operating income declined. Its operating margin fell from 43% to 31%. Net income declined 14% to approximately $15.8 billion. Capital expenditures reached more than $31 billion during the quarter, and free cash flow fell to just $784 million. Now, some of that pressure came from legal charges and severance expenses, not artificial intelligence alone. That distinction matters. But investors were also focused on Meta's plan to spend between $130 and $145 billion on capital expenditures during 2026. Meta is building data centers. It is buying advanced processors. It is recruiting highly paid researchers. It is developing new models, new advertising systems, business agents, consumer assistants, and what it describes as superintelligence. Those investments may eventually produce enormous value, but much of Meta's current AI monetization is indirect. Artificial intelligence improves advertisements. It improves recommendations. It increases the amount of time people spend on Facebook and Instagram, and it may help companies produce advertisements more efficiently. Those benefits are real. But Wall Street wants a clearer bridge between each new data center and each new dollar of cash. Microsoft can say, here is the Azure customer renting the server. Here is the company purchasing thousands of Copilot licenses. Here is the developer paying to use an AI coding tool. Meta, however, often has to say, this infrastructure will make our products better. Better products should increase engagement, and higher engagement should eventually create more advertising revenue. That may prove correct, but it is a much more difficult story to measure. Imagine two stickmen standing beside two identical machines. The first stickman inserts $100. His machine immediately produces customer invoices, subscription payments, and cloud computing fees. The second stickman also inserts $100, but his machine produces better recommendations, more engaging videos, and the possibility of a major new product sometime in the future. Both machines may be valuable, but when money becomes expensive, investors usually prefer the machine that produces visible cash sooner. And that brings us to interest rates. The Federal Reserve has kept its benchmark interest rate range between 3.5% and 3.75%. At higher interest rates, investors can earn meaningful returns from safer assets. They therefore demand greater compensation for waiting on uncertain future profits. A dollar expected 5 years from now becomes less attractive than a dollar arriving today. This is why the market's new rule matters so much. During the first phase of the artificial intelligence boom, the winning company was often the one announcing the largest model, the biggest data center, or the most aggressive investment plan. Spending looked like strength. It signaled ambition. It suggested that a company was determined not to fall behind.
But the second phase is different.
Now, spending without visible returns can look like risk. The new winners must demonstrate 5 things. First, real customers, not demonstrations, not free trials, not vague promises of future demand. Customers paying actual money. Second, repeatable revenue. A one-time experiment is less valuable than a subscription or usage model that produces revenue every month. Third, operating leverage. As revenue rises, profit should eventually grow faster than cost. Fourth, durable free cash flow. The company must be capable of financing the AI race without constantly weakening its balance sheet. And fifth, a defensible advantage. If competitors can offer a similar service at a lower price, today's enormous investments may never earn the returns investors expect. Microsoft currently looks strong on several of these tests. It owns one of the largest cloud platforms in the world. It has deep relationships with corporate customers, and its software already sits inside millions of workplaces. Azure sells infrastructure. Microsoft 365 sells productivity. GitHub sells developer tools. And Microsoft's security products protect the entire system. Each part strengthens the others. Meta has different strengths. It controls some of the largest social platforms ever created. It possesses extraordinary distribution, user attention, advertising relationships, and vast amounts of information about how people interact with content. If artificial intelligence makes its recommendations substantially better, or if Meta creates successful business agents and consumer assistants, the eventual profits could be enormous. Meta may even achieve higher margins by controlling the final product instead of renting computing power to other companies. But today, investors can measure Microsoft's AI revenue more directly. Meta's largest future AI opportunities remain more difficult to separate from the rest of its advertising business. That uncertainty helps explain the market reaction. But it does not prove that Microsoft will win the AI era, and it does not prove that Meta is wasting its money. In fact, the opposite market reaction only 6 months earlier proves how quickly the story can change. One quarter can reveal faster cloud growth. The next can reveal falling margins. A new product can suddenly create revenue. A new competitor can force prices lower. A shortage of processors can become an oversupply. And a data center that looks essential today can become outdated faster than expected. The deeper lesson is not that every investor should choose Microsoft instead of Meta. The deeper lesson is understanding what Wall Street is now paying for. Wall Street is no longer buying artificial intelligence as a story. It is buying the conversion of artificial intelligence into cash. The company that spends the most does not automatically win. The company with the largest model does not automatically win. And the company generating the most headlines does not automatically win. The winner is the company that can connect infrastructure to customers, customers to revenue, revenue to profit, and profit to free cash flow. Microsoft did that more convincingly in this round. Meta did not. But the AI race will not be decided by one quarter. It may continue for decades. The real question is whether these companies are building profitable economic systems or simply building the most expensive machines in corporate history. For investors, that creates one final rule. Never confuse a great technology with a great investment. Artificial intelligence can transform the world. Microsoft can succeed. Meta can succeed. And investors can still lose money if they pay a price that already assumes perfection. So when the next technology company announces another $100 billion of AI spending, do not ask only how advanced the technology is. Ask, who is paying for it? Ask, how often will they pay? Ask, how much profit does each customer create? And ask, what remains after the chips, the servers, the electricity, the engineers, and the data centers have all been paid for? Because in the new era of AI investing, ambition may attract attention, but cash flow earns trust. For more clear, visual documentaries about money, markets, and economic power, subscribe now to Seye Explained. Here, complex finance becomes simple, and every billion-dollar story finally makes sense.